Thanks for tuning in today on Thursday, 4th of June. This is Ainslie News. Today we're talking Fed meet Pavlov, markets unwitting dogs. America is burning in deep recession. Sabre rattling with China escalates. 40 million unemployed. Earnings falling and yet US shares continue to rise. While the answer from many is don't fight the Fed, play the casino, it fundamentally makes no sense. Gordon Gekko is back, baby. Check out this fear and greed index at the moment. And also fear and greed over time in the next chart. So there's nothing to see here. Next chart as well. Moving on, Google Trends for recession, matching the Google Trends for the virus. Many were expecting a correction in the US shares at the 61.8% retracement level, but it never eventuated. Against all odds, it smashed through it, leaving many perplexed as to what the next resistance level actually is, and for how long will animal spirits keep these new highs. Looking at valuations. At Crestcats, Kevin Smith notes on the chart up next, valuation mania still unbroken. Average market cap to GDP ratio when bear markets and recessions bottom out, 0.47, 67% lower than today. Tremendous opportunity on the short side as we take out the fake lows of 2018 and 2020, just shown here in the US total market cap to GDP. Indeed, with falling earnings, we have seen market valuations back up to record-breaking levels. Higher than .com for S&P 500, and even tech shares getting very close to those ridiculous 2001 levels that preceded an 80% fall. The chart below clearly illustrates the disconnect between earnings and share price. You either don't care and are just playing the Fed's got this game, or you somehow think that it will not just be a V-shaped recovery, but it will somehow come back bigger and better. Check out this graph here for the S&P 500 versus corporate profits after tax. And the whole Fed stimulus thesis is not as solid as most people think, reinforcing the arguably Pavlovian effect of their actions rather than actual money. Showing the Fed Treasury MBS purchases since restart of QE. This next chart below debunks the theory that QE has an immediate effect on markets. Whilst, as you can see, the markets responded immediately this time to the stimulatory measures unleashed by the Fed, that was most certainly not the case in 2008, where the market crashed another 57% after the Fed unleashed this new thing called QE. Just shown here in the Fed balance sheet versus the S&P 500 over a bit of time. That reinforces the Pavlovian theory, as in 2008, we hadn't actually been through the impacts of QE given it was a new thing. Looking closely at the chart before, as we've reported over the years, you can clearly see whenever the Fed stopped QE 1, 2, and 3, the S&P 500 came off. Cause and effect were firmly learned. Many know the theory of Pavlov's dog, or the Pavlovian theory, defined as Pavlovian theory is a learning procedure that involves pairing a stimulus with a conditioned response. In the famous experiments that Ivan Pavlov conducted with his dogs, Pavlov found that objects or events could trigger a conditioned response. The experiments began with Pavlov demonstrating how the presence of a bowl of food, stimulus, would trigger an unconditioned response, salivation. But Pavlov noticed that the dogs started to associate his lab assistant with food, creating a learned and conditioned response. This was an important scientific discovery. Pavlov then designed an experiment using a bell as a neutral stimulus. As he gave food to the dogs, he rang the bell. Then, after repeating this procedure, he tried ringing the bell without providing food to the dogs. On its own, an increase in salivation occurred. The result of the experiment was a new conditioned response in the dogs. Without wanting to draw offense, maybe Fed equals Pavlov, QE equals the bell, market equals the dog, salivation, which equals buy. Now, we are by no means inferring QE is purely Pavlovian. Clearly, there is still the direct application of newly created money into banks, providing cheap money to rich folk to pour into the only self-reinforcing because the bell just rang risk-free on asset being shares. With the Fed quietly reducing their QE, albeit of sky-high levels, there is clearly, however, a large dose of Pavlovian behaviour here. Whilst the dog might miss out on a biscuit, investors have much, much more to lose when they learn the bell was, well, literally just a bell. Check out this next graphic here, also showing the S&P 500 index. And that's news for today. Remember, you can always visit ainsliebullion.com.au for more news and, of course, to purchase bullion. We'll catch you tomorrow for the end of the week.